My name is Brittany, and I'm the founder of nix-see. It's a lending platform that supports financial institutions and asset managers with underwriting loans to companies who focus on environmental markets. So I'll get into that in a little bit later on, but I think for now we have a very similar objective with Nature Tech Collective, and that's really focusing on closing that gap in climate finance or nature finance to really ensure that nature-based solutions are a key part of helping the world adapt to climate change. So just as a quick agenda, I'm going to start first by kind of clarifying what exactly I mean when I say financing, and specifically blended finance, because there are some discrepancies in kind of how that term is used throughout this ecosystem. After that, we'll go into specific mechanisms that have been used within the financial, let's say, sphere to actually facilitate investment and create for-profit solutions that have incentives in line with both public and private sectors to really get nature restoration projects off the ground. And then dive into specific use cases where we can have some chance for discussion after that. So we'll take a small break at that point and really kind of get into any of the nitty-gritty questions around these specific examples and potentially how they relate to any of your projects. And then after that, we'll do a quick overview of nix-see and the role that we play in this overall landscape of financing for nature restoration. So I hope that sounds good. As I mentioned, I can't see the chat or any questions, so please feel free to just jump in. Let me know if you have anything urgent that needs to be addressed in between the breaks for questions. So starting off, climate finance, we know there is a large gap. I'm sure we've heard this discussed multiple times. We have a few numbers that can put it anywhere between $1 trillion to $9 trillion in financing that's needed between now and 2030. So the UNEP estimates about $387 billion per year that is needed to close the gap in infrastructure that would help each country meet their commitments to the Paris Agreement. And we have the Climate Policy Initiative that shows an increasing need over time. And what this means is that obviously as the effects of climate change get worse and investment continues to miss the mark, then the need becomes even greater and increases exponentially over time. So ideally, we would like to avoid that and increase investment now. And then at that case, the key question then becomes how and why and where is that incentive? This is missing a picture, so I'm going to go ahead and zoom in on the graph that I made. Let's see. Can everyone see this pie chart?
Yep, I can.
Okay, great. So we're looking at climate finance by sector where it's currently broken up. And what we see is that the majority of it is focused on the energy sector right now. I think that would be most evidenced, for example, in the US with the Greenhouse Gas Reduction Fund, where we have a lot of, I think over 27 billion funding that's allocated specifically for renewable energy infrastructure and for upgrades itself. Then after that, we move towards transportation and agriculture as the two largest sectors, and manufacturing after that. So this is all a mix of renewables, energy infrastructure, as well as energy efficient upgrades in each of these sectors. And then we have a small portion of the funding for climate finance that's really allocated towards any emerging technology that includes CDR or alternative energy. So this goes beyond, let's say, a typical solar power plant. It would maybe branch into small modular reactors, so a little bit more of that experimental or newer renewable energy bucket is where that financing is from. And then we have nature tech solutions that focus on CDR and different means of adapting to biodiversity loss. So very small bucket of the current financing that is available is actually what the sector is working with. But within that, there are some pretty innovative mechanisms. So I'm going to hope that this, great, graph shows up. So within this bucket of financing, we have quite a few variations of methods for funding to get allocated to conservation. when I say financing mechanisms, I do not just mean the purchase of carbon credits. So we have that kind of laid out on this chart here, where we have carbon credit purchases from the public sector or the private sector through both compliance markets and through voluntary markets. And of course, that is a means of kind of creating these units of output that can then be purchased and measured and communicated to either meet regulatory compliance requirements or to meet sustainability initiatives that are then marketed. But that is really just one piece of the pie. So moving beyond compliance and cap and trade programs, we also have conservation and mitigation banking. And these in the US are locally run, I would say, government-funded initiatives in which companies actually have to ensure that they're adhering to EPA or public policy initiatives to conserve a specific, let's say, wetland, if they want to do business in another area. Or they have to make sure that a highway is not actually causing too much environmental degradation in one area, and so they'll employ an environmental engineering firm to ensure that that construction is carried out appropriately and doesn't cause any additional environmental harm. So a lot of that kind of overlaps very strongly with expertise within conservation who understand the environmental impacts and need to make sure that those, let's say, metrics such as biodiversity or maybe water conservation are met as this construction is taking place by either a public entity or a private entity. And within that market itself, there's a lot of buying and selling of specific credits. So this, is very similar to nature-based credits or biodiversity units, but actually, I would say there's probably about 10 to 15 years of experience in actually measuring what a specific increase in a species or, let's say, healthy soil or different means of water conservation and where that is flowing and what it's being done with. There's a lot of experience there in kind of measuring those units and then selling them to either public or private entities. So that's one example outside of the VCM where we see funding going into conservation. Another is sustainability-linked lending. So this, for example, is carried out by a bank in New Zealand, and these are more linked to pay-for-performance contracts as well. And so what that means is that you have a specific interest rate or perhaps debt forgiveness, or even on top of that, you would say that the loan itself could be extended, so you could get an increase in financing that's actually available if specific environmental outcomes are met. So this could include the carbon that's sequestered. It could include implementing a new form of, let's say, agricultural tilling that would be used for different farms. So all of that financing and those specific environmental metrics themselves that are linked to the loan, we've seen most commonly within the agricultural sector. So I'm just speaking of one specific use case in New Zealand, which I'll get into a bit later. But again, what's important there is that we have either the interest rate, the ability to extend financing, or debt forgiveness that is actually tied to environmental outcomes. And all of that work is financed by companies who are already bringing in revenue and have the ability to repay a loan. So it's not necessarily paying someone for their services, but rather saying, hey, look, we know you're running an operational business. We have additional financing for you. We can give it to you at a discount. It's a lot easier of a loan to get because we know you're meeting these environmental requirements that are of value to either a specific public entity or maybe towards a bank that wants to meet its net zero commitments. So that's sustainability linked lending. Outside of that, kind of staying away from the credit markets, we have green bonds that are being carried out by both NGOs at a larger institutional scale and individual banks. And more recently, we have debt for nature swaps, which are pretty interesting, but those are carried out by international development banks, and they essentially allow different countries to get access to either extended financing for development needs, economic development needs, or to actually forgive some of the debt that's outstanding with these larger banks like the IMDb, if they're able to conserve land specifically for the purpose of increasing biodiversity. So as we can see here, this is a rather complex group of different mechanisms that are all somewhat linked in the sense that you could have the credit markets kind of driving the revenue for the companies that are then able to take advantage of these different financing mechanisms. So there is a specific point at which purchasing and selling credits is still necessary because it's able to drive revenue that then unlocks additional financing moving forward. But that was a long slide, so we'll jump into the specifics. Just on a local level, if we look at an example, we have the convergence between public and private capital, and that is actually what is known as blended finance. So this is where you have examples of public funding that is used to either create a guarantee or create additional incentive for private capital to come in and say, look, I know this loan is either more secure or it will increase in value because there is someone who wants to purchase this instrument as well. So it makes sense for me to come in and buy, let's say, a rather safe bond with a specific yield that I know I can get a return on. So one of my favorites, and this is actually carried out here in California, is the Yerba Forest Resilience Bond. And this bond is actually backed by both philanthropic donors and public funding. And so what happens is the investors will essentially go out, or I would say fundraisers. This NGO goes out to raise a bond, and they tell the bond issuer, or they are the bond issuer, but they tell investors that they're able to actually get a return because they have someone who is lined up to contract the services of this ecosystem restoration firm. And what that firm does is go out and ensure that 1,500 acres of the Tahoe National Forest are being protected. And as part of that, you actually have environmental credits that are being generated. Those credits are then purchased by a local water agency. And in order to ensure that those credits continue to see demand, you have additional philanthropic capital that is coming in to kind of boost the value or the security of the company that is actually issuing those credits. So you know that revenue is coming in, and as an investor, you know you can then get a safe return on any bonds that are issued and that you're purchasing. And so this is one example of where philanthropy can come in and kind of help, let's say, create an extra incentive for investors to bring more capital into this space. And what that bond does is, like, with the ability of credits, with the ability to get more funding through loans, they can then expand into new projects instead of being really constricted to this individual project where they may have just sold credits to a local water agency and then had to wait for another contract in order to continue to developing. And it really helps them avoid getting stuck in this bind where they may not have the financing to go out and develop a new project because they don't have the credits secured ahead of time, and yet have to go and pitch a project that doesn't necessarily exist yet and try and sell these credits ahead of time. So unlocking that kind of double-edged sword is really where we see kind of the most innovation within this space. So that was this Blue Forest initiative, and you can go to blueforest.org to learn a little bit more. I will say I probably butchered the full explanation of that, so I'm sure anyone there would be happy to share a bit more about kind of the inner workings of how that bond actually functions. So that was at a local level, and moving on, we'll actually look at one of the blended finance options that is taking place at an international level. So this is carried out by two agencies. Of course, we have investors who are purchasing bonds, and then we have both the Inter-American Development Bank and the US DFC that are actually helping to facilitate the issuance of this bond. So those are two international development banks that kind of act as this public sector guarantee to really reduce the risk for investors who want to participate in purchasing this bonds. So essentially, this one is super interesting. It runs until 2041 and gives investors a 5.6% interest rate. So that's fixed income, meaning they're making that back on lending that capital. And we see sovereign bonds with typically a higher yield, but what the advantage is here is that it's considered less risky. And this is because these international development banks are coming in and playing two roles. The first is by providing a credit guarantee. So saying, hey, look, if this defaults, there's an institution there that's willing to repay that capital. And then the second is through political risk insurance, meaning that if for some reason the project is compromised, that there is another form of capital there that can actually be used to meet the requirements of the investors to ensure that they get their funding back. And essentially with that repackaging of the financing and having that guarantee there for investors, it means that the country itself has their debt reduced, so they get to pay less back. And there's around 450 million of funding that is now allocated specifically for conservation to take place. So, I mean, I think it's a clever deal. It's like, hey, we'll, on one hand, give investors a guarantee that they can either invest and make a profit or get their money back. And on the other, in order for this country to reduce their overall debt, they actually just have to commit a specific amount of funding to conservation work. So that was a good example, I think, of that being carried out on an international level. Okay, and another, let's say, blended finance example that actually has taken place through the role of international development banks. This one is called the Rhino Bond, and it's organized by the World Bank. And it really focuses kind of both on this idea of creating a guarantee for investors, as well as having these outcomes-based measurements that are key to conservation. So essentially, the Rhino Bond is specifically looking at a population of rhinos in a specific area and wants to measure that increase of these rhinos over time. And so the bond is issued, payments are made by investors to ensure that this work is taking place. And investors then receive payment once the population of rhinos has actually been demonstrated to increase, as opposed to just receiving these repayments on a regular schedule. So the idea there was that there was a little bit more of an incentive, or let's say pressure, from those investors who purchased the bond to actually meet these commitments and ensure that those conservation goals are met. So it's a different structure for sure. You have a different, let's say, layer of incentives that are aligned, but you actually get a much higher return on this. So if we look at the numbers a little bit more in depth, I think that's anywhere between, what is it? Nothing. So if there is no increase in population for rhinos to over 4% increase, you actually see the multiple of the success payments per $1,000. So if there are no rhinos, bond issuers essentially don't get any profit. But if there's more than a 4% increase in the population, you see a, what is that, USD per calculation amount of $1,000. So 91,000 conservation success payment. So I don't know exactly how that's broken up, but I can share the source after this if anyone wants to go into detail to really see how those numbers are actually broken down per unit. So last but not least, this final example goes into what we were discussing earlier with sustainability-linked lending. I think it's another important example because it kind of breaks down this overall financing landscape and brings it more into local businesses and understanding how financing mechanisms can actually support individual businesses as opposed to just countrywide loans through international development banks. So the Bank of New Zealand, which is part of SAFI or SAFI, basically very similar to the Task Force for Nature-Related Financial Disclosure, also has a similar reporting structure that the Bank of New Zealand participates in and wants to align their commitments. And for that, they have performance-based loans, as I mentioned earlier, with the option to link interest rate, debt forgiveness, or this credit line increase, specifically to emissions reductions in the agricultural sector. And so these loans, as I mentioned earlier, are issued with the capital being allocated to a specific company. And then over time, you have third parties that are responsible for auditing and ensuring that those commitments are made in order to essentially reassess the loan over time. So this requires a continuous monitoring and verification, both on behalf of the borrower and on behalf of the issuer, who needs to go and revise any interest rates or perhaps repackaging that needs to happen. But the key advantage here is that we kind of take these larger scopes and larger projects and boil them down to individual companies, individual business owners, whether that be agriculture firms or environmental engineering firms that are able to take advantage of this capital and put it to work right away. So thank you so much for your patience with all of that. We're going to break for questions right now. And then after that, I'll go into the role that nix-see plays in all of this, but hopefully that was clear. And I'm going to stop sharing the screen now so that I can see your beautiful faces.
Thank you so much, Brittany. And yeah, floor open for questions. Does anyone have anything they'd like to ask at this point in time?
Hi, Brittany. It's Rajesh. I'm a founder of a company called Indelible. My focus, actually, I've been involved in fintech for the last 15 years, predominantly focused in Africa in cross-border payments. Last year, I essentially pivoted. I got out of the remittance world and moved into looking at biodiversity. It's kind of a personal passion. My roots are East Africa, and I've always had this thing that's been burning at the back of me. So I launched a crowdfunding platform specifically focusing on connecting retail and corporate investors into high-profile projects. So when you mentioned the Rhino bond, I'd actually read a little bit about this the other day. It's actually really it's just fascinating. But blended finance for me is a learning curve. What are your thoughts on crowdfunding? Because what we have is a product. We have really good projects, mainly because of the contacts I've built up over 15 years in Africa. But I noticed that crowdfunding, I don't know if it was in the slide or if it's not relevant to what you were presenting, but I just wanted to get your thoughts on that.
Yeah, so crowdfunding would fall just slightly outside the scope of blended finance, because with that blended finance, you're looking at this core element of having some public funding or philanthropic capital that's used to kind of de-risk the investment. And when I say de-risk, I mean through these credit guarantees or form of insurance. But I think crowdfunding itself, so it kind of comes back to this core question of, where that incentive lies for the investor, and how these individual projects are actually structured to provide that return. So a lot of the times, I think, just watching, in my personal opinion, the evolution of the venture space, of venture capital kind of play a role in this space, and kind of hedge bets on whether or not the carbon market itself would actually create that revenue stream that would kind of 10x a VC investment in a company or in a specific project or group of projects over time. So as a crowd investor, I think personally I would approach that project with that same sense of evaluation. It's really, where is that revenue coming from that's going to kind of guarantee an increase in the valuation of the company? Is it through just the sale of credits? Is it through potentially other sources of revenue? And if that's the case, what kind of return am I expecting as an investor? Is it something similar to VC, or is it a little bit, slower over time? Maybe I own, it's a revenue share mechanism where I own a portion of the company and get paid out in something similar to dividends. So I think there's just it depends on really where that expectation lies on behalf of the investor, in my opinion. And I definitely think crowdfunding can play a role in terms of maybe a smaller let's say, investment size that a project is needed, but then the clarity around the expectations should be laid out. But that last part is my own opinion. So happy to hear your thoughts on that as well.
No, I agree. I mean, the reason I started with the crowdfunding in the UK, at least, there are sort of four types of crowdfunding. You have reward-based, equity, loan, and donation. We fall more in the reward space. So we've built the product mainly to get to market very quickly. I have relationships with central banks across Africa just because of the work I've previously done, and we've managed to secure projects protecting, for example, in Kenya, Old Bajeta, the last two northern white rhinos. And in Ghana, we're working with the government of Ghana for a reforestation project at a heritage site linked to transatlantic slavery. But the idea was to connect initially smaller investors that want to do something positive but are not able to find almost a link or trust in some of the opportunities that exist, because it can be quite, even for myself, I mean, there's a big learning curve in terms of understanding the sort of various products that exist out there and getting the buy-in to contribute. But the other side is, I'm speaking to tier one banks and corporates at the moment to bring them in and onto the platform. So a good example is in Sweden, you have Milky Wire and the work that they've done with Klarna, who have, they've essentially dumped, I think they've invested around $21 million or more into transformation funds for nature and climate. So it's kind of bringing those pieces together. But I agree. I mean, it's very much the other end of the scale compared to what you were talking about.
Yeah, I think there's it's important as well to make the discrepancy between who falls within the investor side and then who falls within the credit purchase side, and where corporates kind of play that stronger role. So Klarna or Milky Wire, yes, they can say they're investors in projects through purchasing credits, versus becoming kind of working with their CFO office and kind of creating a new way or a new business unit to actually drive revenue generation through project finance itself. So personally, just in building Nyxc, we've seen that companies are kind of, still learning maybe what this concept of either supply chain finance is or individual project finance and how to turn that into a for-profit business unit. I've definitely heard of it, so it exists, which is great. And potentially maybe they would play a role within your platform as well, or just through the buying and selling of credits themselves, from the corporate perspective as another way to kind of finance these projects. But yeah, sounds good.
Thank you.
Good work.
Thanks, Rajesh. Okay, any more questions? Lee Wei.
Hi, Brittany. Hi. Thanks for the presentation. It is very helpful. So I'm a startup founder, Seedling Climate Alliance. So we are trying to move private capital into the nature investing space. Essentially, we're exploring the idea of setting up a fund by pooling different kind of project types and revenue streams and combining with offtake agreement, which has been quite emphasized in recent conversations to help secure the future revenues. So I guess my question to you is, I have heard the blended finance is very difficult to do in reality. The process is very lengthy. And so we have also applied to the Climate Finance Lab. So besides that route, I was wondering if there is any way to go with blended finance, what are other routes that's potentially feasible?
Yeah, definitely. I mean, the sources for where to find this capital and how to kind of leverage it is not easy to identify. It seems like these larger bonds are kind of these one-off events. But I know the USDFC, so they have, a strong climate agenda, and they are big on providing guarantees to portfolios. So if there is an entity that's doing the financing or making loans specifically to these projects, USDFC at an international scale, so they have to be outside of the US, definitely has some room for financing there, or collaboration there. And then on top of that, in the US, we're still trying to understand how the Greenhouse Gas Reduction Fund will trickle down, but that funding is for all decarbonization initiatives. And so it is essentially right now allocated mostly to consumer loans for energy efficient upgrades, but I know there are some larger recipients who are actually making loans to small businesses as well. So if those businesses are within environmental markets, there is a likelihood that Greenhouse Gas Reduction Fund could actually play a role in some of that. Yeah, the blended financing options that could help essentially lower interest rates or provide that de-risk capital to lower interest rates for project developers. So those are the two examples that I can kind of think off the top of my head. And I would say, I don't know what the Bank of New Zealand is doing, but if there's any connection there, perhaps their SAFI commitments or whatever loans that they're actually making available to the agricultural sector could be expanded to some of the projects that might be carried out in that region as well. But yeah.
Thank you, I appreciate it.
Yeah, no problem. Okay, I'm gonna.
I have a quick one. It does seem like it's quite a complex process. At what point in their kind of journey should different personas within the nature tech ecosystem start thinking about blended finance?
Yeah, I would say blended finance, leveraging that capital for an investment vehicle. So this would be fund managers that would be interested in taking advantage of this, or perhaps lenders within the philanthropic or donor space, concessionary capital, that are looking to be able to understand how they can use their financing to create more of these for-profit or incentive mechanisms for investors to come in outside of the direct purchases of credits. So definitely more on the investor side is where this can be leveraged. And then in terms of either technology that's being provided to project developers or project developers themselves, it seems like the core objective would still be to go out there and make sure that they're generating revenue, either through the sale of credits or other revenue streams, to then go and take advantage of this financing to expand the growth of their business.
Thank you.
I have a quick question. So often the advice that we get is to go after family offices who, for a blended finance approach, that's usually the same institution that you're targeting, or the same group of people, but maybe there's two parts to it. So I just want to understand, is that your experience and how you kind of approach blended finance in terms of getting people to one, invest and donate at the same time? The other thing, I want to do a bit more research, but I can't access your website from the UK. But is it geo-locked here or something?
No, one of our servers is down, and it's very
okay. I'll try tomorrow.
in the background.
Okay, no worries.
Yeah, sorry about that. Always happy to jump on a call later, and I'll go into a bit about nix-see as well. So when I think of blended finance, I really think of like larger institutional bodies coming in and providing like de-risking capital to investment like firm portfolio managers. So when you say that you've had advice to kind of work with family offices to take advantage of it, I think I'd need to understand a bit more about like what type of financing you're seeking, and if these family offices, like what role they're playing as investors.
Right. Yeah. Sorry, I didn't do the introduction, did I? Yeah. So yeah. So we're a startup. We just finished the Techstars sustainability program in June. So we basically created what we call the green standard token. So it's a currency backed by the value of protected lands. So in the same way you would used to back money with gold, and the value of gold, we do that with the value of land. So the revenue is, the for-profit element is our limited company in the UK, which basically monetizes the restoration of nature on that land. So with all the different things that you're talking about in your project. So that's the kind of VC angle. And the land sits in a non-profit and is owned by nature. So within our legal structure, the beneficiary of the asset, which is the land, is nature itself. So we've kind of created a system where, yeah, it's designed to make land, the vision is the largest landowner in the world will be nature. So there's two angles there, right? So and because we're new, we're targeting the family offices for blended finance before we go above that to the corporate level. Yeah, that's just to frame it a little bit for you.
Okay, cool. So if I understand, the value of the token then has, let's say, the value of the land itself. And then on top of that, that token would increase in value due to the kind of revenue generating activities that take place, aka the restoration activities that are kind of serviced out.
Only if that increases the equitable value of the land. So the token only represents the value of the underlying asset. The revenue, so the dividends and the revenue that comes from the land, sits within the for-profit entity. So we've done that so that GST doesn't, which is the token, doesn't become a security. It avoids a lot of financial regulation in the EU and the UK as well. So we've structured it in that way. So the underlying shares, in the limited company, that's where the revenue from land goes. But that is also a cap profit organization. So any dividends that get paid out have to get paid in GST. So everything within the system serves nature. So even profit for shareholders is in GST as well.
Okay, cool. And then as
it's a
an investor,
structure, sorry.
No, it's okay. I mean, I'm like, I love this stuff. So, and then as an investor, that you're essentially selling equity in the for-profit entity that is
Correct.
contracting those services. Cool. So I mean, in terms of the ways, I wish there was like a smaller banks or smaller funds that would participate in providing guarantees on a project by project basis, as opposed to just through these larger institutional like bonds. And I think that is a big hole that needs to be filled, and something that, you know, just as a founder myself, I'm also putting out there for any institutions or maybe investors or portfolio managers, banks, to actually take part in. I think there's one example that may be out of scope because it's in the US and not in the EU, but Washington's cap and invest program. So the state of Washington itself, they have a cap and trade program where they then reinvest some of the revenue that comes from that tax that's actually initiated through the cap and trade, and they're able to buy credits from projects that lie outside of just the local jurisdiction of Washington itself. So that's kind of one example where public funding can kind of disperse to projects that are outside just the specific cap and trade institution or program that's set up. But it's based here in Washington State. And the good news is that that was newly reinforced during the last election. So that program isn't going anywhere. And that was one win. One win over here. But yeah, sorry, couldn't help anymore on that one. But it's cool. I like the company.
Great. I think we have time for Lee before you launch into an explanation about nix-see. Lee, come on up.
Hey, thanks for their presentation. I just had a couple thoughts that came to mind. So I think Rajesh brought this up a little bit from crowdfunding, but I also just think about, like, isn't there an opportunity with partnering with NGOs or nonprofits that are bringing the concessionary capital, right? I mean, that's how we're thinking about it for our development projects in the Philippines. So we're working with people's organizations, which are private groups, and we're obviously a private company there, but we're protecting areas around a national park, and there's an NGO that's already working there as well. So really, it's just structuring a project that by its nature is a blended finance project. So that's the way we're thinking about approaching that. And then additionally, I think there's opportunities working with NGOs and for product sales. So in Uganda, we're working with a group that's like an NGO that's been there for 20 years. They work with a lot of farmers that are growing vanilla. And now we're importing vanilla to the US through a private company, right? And selling vanilla extract. But obviously the NGO we can drive finance to that NGO to increase production capacity and do other things for the farmers, right? So then, you're not thinking about trying to go after these, huge sources of concessionary capital or, hundreds of millions or billions, but trying to figure out how do you do the blended finance in the project design itself or with smaller groups of people. Anyway, we don't have massive success yet, but that's kind of the way we're approaching. I'm curious to think about your thoughts of structuring it that way.
Yeah. So before nix-see, I launched Saru, which was a mobile app, and essentially it motivated people to work out by allocating donations to NGOs that actually participated or did that type of work for conservation or ecosystem restoration. And so to me, I definitely think that's a viable option and it works very well. I just have two different buckets in my head. There's one, contracting with NGOs or as a nonprofit entity to actually provide the workforce development training and on the ground monitoring and actually understanding, and creating that work that's being done to restore the land through either planting trees or monitoring specific species and kind of making some environmental engineering changes there, and then contracting those services and then integrating that into more of like a supply chain for a specific project developer. So if that's like the term blended finance and how NGOs can play a role, like makes perfect sense. I just think from the scope that I was coming from, it was a little bit more purely on the project finance side as to how solely capital itself can kind of play a role in unlocking even more funding. But yeah.
Cool.
Great. Well, if that's it, we can probably move into the last part of this webinar, which is just kind of like an introduction to your platform. And anyone feel free to ask questions in the chat as well that could potentially be answered at the very last moments of this webinar or afterwards. Oh, and you're on mute. Sorry, Brittany.
And the screen was not shared. Thank you, Paige. Thanks for moderating too. So it's very helpful. Okay. All right, are we good? Can we see the screen?
We see it.
Great. So nix-see itself, after all of that, I mentioned starting a mobile app. We had about 3,000 active users. It was bringing in funding for nonprofits, but not quite enough at the scale that needed to make a dent in this $9 trillion gap that we're expected to face by 2030. So I decided to take a step back and figure out a little bit more about the process of project development, and of course wanted to start my own project working with friends and family to actually plant some trees and restore some land, some farmland that kind of had a family history of owning in the past. But it turns out that couldn't be done because at a larger scale, the process of actually selling the credits required reaching out to a larger corporation, which we all know is rather complex for an individual, much less an individual project. And then on top of that, the proof that we kind of needed to get to in terms of environmental restoration required upfront capital. That capital which couldn't be secured until we had purchases of credits. So this double-edged sword is really kind of what drove me to kind of innovate within this space and break that barrier so that it's possible to get access to financing to have additional working capital for projects without necessarily having to sell all of these credits ahead of time. And that's where we also found a massive gap in financing that's available. So that gap can be closed, meaning it's okay to get financing ahead of time, kind of if you're one of these larger project developers and can go to a bank like JP Morgan and ask for $50 million. They're willing to do the math and understand the value of that loan and make it because the transaction costs on a $50 million loan is worth it. It's not necessarily worth it for a company that's maybe seeking $25,000 or a small business that maybe needs $500,000 to get a new project off the ground. In fact, even up to $5 million, banks aren't necessarily willing to go into the complexity of assessing the environmental project in order to make that loan. And so this is where nix-see comes in. What we're doing is really streamlining the underwriting process, or the process of assessing the risk on a specific loan for companies in environmental markets, meaning that loans under 5 million can now get serviced by non-bank lenders, which includes philanthropic institutions and small banks as well, so CDFIs, and of course larger institutions who want to take advantage of working with smaller businesses and making sure that they're meeting their sustainability commitments. So the way that we actually do that is through 3 different areas. The first is with the marketplace, meaning that we're actually showcasing different project developers themselves and some high-level overview of their financials to different lenders who want to ensure that they're meeting their initial lending requirements. We also have an underwriting algorithm that is meant to kind of streamline this process of assessing each individual loan and really support that risk assessment. And then lastly, we actually offer the option to automate the loan and the loan servicing through a lending protocol. And that last part, participating in the protocol and taking advantage of the platform to make that loan is optional. And in that case, we would charge a transaction fee. But if lenders have the ability to kind of, the infrastructure themselves to do their own diligence on top of what nix-see is providing, as well as make the loan, essentially it's the lenders who are paying for this platform and for these services through a SaaS subscription. So it's completely free for a borrower to come on the platform and to get connected with different lenders, kind of understand through a marketplace solution who would be providing the best rate and at what terms. And then it's the lenders who pay nix-see to be able to get support with their risk assessments on these companies. So a little bit about myself. I probably should have started out with this, but I've been in climate tech for about 10 years. First started off studying climate policy with a master's in global energy policy, then went on to work in Berlin, where I launched the sustainability platform, working with energy utilities and suppliers to both invest in and then pilot with different startups. And after that, built the mobile app, which we heard the story a little bit. We heard the story about a little bit earlier. Technically, we have Kyle, who is our technical lead, and he actually built our product and has our MVP out on the market. So he comes from a background in fintech and specifically working with AI to create market intelligence, and has a background in analytics on fixed income. So we're also complemented by George, who is an awesome advisor. He has about 25 years of experience within environmental markets, specifically in policy advocacy and for developing individual projects. So understands the compliance markets, where that revenue comes from for different mitigation banking projects and how to finance them very, very well. And we're happy to have him on our team to help us give some feedback when we need it. So if there are any specific questions about nix-see and maybe how to get in contact with different lenders who are interested in this space specifically, email me right now and I'll set up a demo as soon as our server's back up and running. You can also follow along by joining our Discord, which has links to all of our socials, and just kind of keep up to date with what we're doing and who we're working with there. So I'll stop there for any questions on nix-see.